Have you ever found yourself just staring at your options trading screen, kind of wondering, okay, what if?
Yeah, what if the stock suddenly takes off? Or what if
Yeah.
it drops like a stone?
Exactly. How much could I actually make here?
Hmm.
Or maybe more importantly, how much could I realistically lose?
Mm.
Today, we're really getting into something fundamental for anyone serious about trading options. It's all about understanding profit and loss diagrams.
The P&L diagrams, absolutely essential.
We've been looking at some fantastic material, especially, from the Automated Options Trading Podcast. Those experienced traders over at advancedautotrades.com really break it down well.
They do. It's a goldmine, particularly if you're newer to options and want to actually see your strategies.
Yeah, we've gone through their explanation of how these visual tools basically give you X-ray vision into your trades. You see exactly where you make or lose money.
Right now, yes, but also critically at expiration, it's almost like having a crystal ball for your potential outcomes.
So our mission today.
Our mission is to really unpack these diagrams for you. We
Yeah.
want to demystify how they work, show you why mastering them is, frankly, non-negotiable for building solid, profitable option strategies.
We'll show you how they reveal everything, right? Break-even points, max loss, max gain.
Precisely, turning these, sometimes complex ideas into something you can grasp visually almost instantly.
Okay, let's start at the beginning then. What exactly are these profit and loss diagrams? What are they showing us fundamentally?
At their core, think of them as visual aids, strategic blueprints, really.
Blueprints, I like that.
Yeah, they show the exact financial outcome of an options strategy when it expires, based purely on where the underlying stock price ends up.
Oh, it connects the stock price to your bottom line.
Exactly. It's like a complete map of potential financial outcomes. They help you understand every scenario. Your break-even points, your maximum possible loss, your maximum gain.
It forces you to think ahead.
Absolutely. It forces you to see the potential profit zones, the risk zones. It's all laid out.
So visually, what are we looking at? What are the basic pieces on the chart itself?
Okay, picture a standard graph. Usually on the left side, moving vertically, that's your profit and loss.
Up is profit, down is loss.
Correct. There's a zero line, the horizontal axis, basically cutting through the middle. Above that line is your profit zone. Below it, your loss zone.
And the bottom axis.
Across the bottom, horizontally, that's the stock price. Typically moves from lower prices on the left to higher prices on the right.
Okay.
And that line running through the chart, sometimes called the strategy P&L line, that's the key. It tells you where you make money, how much, and what stock price you need by expiration to get there.
So everything condensed. Max profit, max loss, break-evens.
All in one simple graph. It's incredibly powerful for seeing the shape of your risk and reward.
That makes sense conceptually. Let's make it real with some basic examples. Say, a simple long call option. What story does its diagram tell?
Right, a long call. The diagram for that is pretty clear. It shows limited risk on the downside.
Because you paid a premium.
Exactly. You pay that premium to get in, and that amount, that debit, is the absolute most you can lose. The diagram shows a flat line at that loss level below the strike price.
And the upside.
That's the exciting part for a long call buyer. Once the stock price gets above your break-even point, that's the strike price, plus the premium you paid, your profit potential is, well, theoretically unlimited.
So the line goes up sharply.
Slopes upwards quite steeply, yeah. It visually shows that accelerating profit potential as the stock rises.
Okay, now let's flip it. What if we sell a call option?
Oh.
A short call. How does that change the picture on the diagram?
The short call. Yeah, the diagram basically inverts. With a short call, your profit is capped.
Capped at the credit you received.
Precisely. You sell the option, collect a premium, and that's the most you can make. The diagram shows a flat profit line up to the strike price.
But the risk.
And here's where it gets, well, potentially dangerous if unmanaged. Your risk is theoretically unlimited if the stock price keeps climbing higher and higher.
So the line goes down sharply past the strike.
Very sharply. It's a stark visual. Capped profit, potentially unlimited loss. It really underscores why managing risk is so critical with short, naked calls.
Okay, one more basic one. What about selling a put? A short put. How does that diagram look?
A short put is interesting. You want the stock to stay above your strike price or go higher.
Similar profit profile to the short call then.
In terms of being capped, yes. Your maximum profit is limited to the credit you received for selling the put. So again, a flat line above the strike.
But the risk is different from a short call.
It is. While the risk is significant, it's not technically unlimited like a short call. Your maximum loss occurs if the stock goes all the way to zero.
Right. The stock price can't go below zero.
Correct. So the loss is capped at the strike price minus the premium received times the number of shares. The diagram shows that profit plateau, then a straight line sloping downwards as the stock price drops below the strike, heading towards zero. It clearly shows substantial risk, but defined risk.
It's really clear how these basic building blocks have their own visual signature. But, options trading often involves combining these, right? Can these diagrams help us visualize more complex strategies?
Absolutely. This is where they become incredibly powerful. They let you visually combine strategies and see the resulting payoff profile.
Like what? Give us an example.
Okay, consider something like a bullish call debit spread. You're buying one call option, but at the same time, you're selling another call option at a higher strike price.
Okay, two legs.
Right. And the P&L diagram for the spread clearly shows how combining these two limits your risk.
Limits it how?
It limits your risk on the downside, similar to the long call, but it also limits your potential profit on the upside because of that short call you sold.
So it creates a defined profit zone and a defined loss zone.
Exactly. You get a strategy with limited risk and limited reward. The diagram shows this bounded outcome. It's great if you have a directional view but want to reduce the cost or define the risk more tightly than just a long call.
And we can layer on even more complexity, like with something that's not even about direction, like a short iron condor.
Yes. The short iron condor is a perfect example of a strategy designed for when you think the stock won't move much.
Profiting from low volatility?
Essentially, yes. It involves selling a call spread and selling a put spread simultaneously. The P&L diagram looks quite different. It typically shows a wide profit zone right in the middle.
Like a plateau?
Kind of like a plateau or tent, yeah. It means you make your maximum profit if the stock price stays within a specific range between your short strikes at expiration.
And the diagram also shows the risk if it moves too much.
Clearly, it shows the points where you start losing money if the stock breaks out of that range, either to the upside or the downside. It visually defines that sweet spot where you want the stock to stay.
Theory is great, but let's ground this in a real trade. The source material mentioned an XOP strangle. How did the P&L diagram help understand that specific trade?
Right, the XOP strangle. A strangle involves selling an out-of-the-money put and an out-of-the-money call. On a platform, say Thinkorswim like they used, you'd see the familiar P&L on the vertical axis, stock prices on the horizontal. The diagram for the strangle would visually pivot around the two strike prices, the 26 put and the 35 call in their example.
Those strikes define the boundaries.
Exactly. They anchor the whole picture. And the current stock price, around $30.75, $30.77 at the time, would intersect the P&L line, showing the current theoretical value.
So what did that specific diagram tell us about profit and loss for the XOP strangle?
It showed that the maximum potential profit, about $164 in their case, occurred if XOP stayed between $26 and $35 at expiration, that flat top of the tent shape.
The profit zone.
Precisely. The diagram makes it crystal clear. Stay within that range, you collect the full premium. But crucially, it also showed the risk outside that range. For instance, if XOP went up to $37 at expiration.
Outside the $35 call strike.
Right. The diagram showed a loss starting to mount, maybe a little over $200. If it went even higher, say $38, the loss grew to around $450. You could literally trace it. Find $38 on the bottom axis, go up to the P&L line, then go left to the vertical axis to see the loss.
Very intuitive way to see the risk accelerate.
Exactly. It makes the potential outcomes tangible.
Now, this leads to something that often trips people up. Many platforms show two lines, right? Often a green one and a purple one. What's that about? Why two?
Ah, yes, the green and purple lines. This is a really important distinction, especially for managing trades day to day.
Okay. Break it down for us.
The green line typically represents your profit and loss at expiration. Think of it as the final score. This line shows what you will make or lose if you hold the trade all the way until the options expire, based purely on the stock price then.
That's the theoretical end result.
That's the theoretical end result, your ultimate target based on the strategy's structure.
And the purple line?
The purple line shows your profit and loss right now, today, or at any point before expiration.
Why is it different?
Because it accounts for factors beyond just the stock price at expiration. It includes the current market conditions, the level of implied volatility in the options, and, very importantly, the remaining time value.
Time decay, theta.
Exactly. Theta decay, vega changes due to volatility shifts. These things constantly affect the current market price of the option. The purple line reflects that dynamic real-time value. The difference between the purple line, today's P&L, and the green line, expiration P&L, is largely that remaining time value and volatility premium.
Can you give a quick example of how understanding this helps using that XOP trade again?
Sure. For the XOP strangle, maybe at a certain point, the stock price, say $30.83, put the purple line at a profit of, let's say, about $94.
Okay, profit today.
But the green line, for that same $30.83 stock price, showed the maximum potential profit at expiration was still $164.
Ah, so there's still money left on the table.
Exactly. It tells you there's roughly another $64 or so of potential profit remaining in the trade, mostly from time decay, theta, if the stock stays put and you hold it until expiration.
That's huge for confidence, right?
Absolutely vital. Imagine the stock moves slightly against you and the purple line dips into a small loss, say minus $100 today. If you only look at that, you might panic and close the trade.
Yeah, cut your losses.
But if you look at the green line for that same stock price and still shows you'd make your full profit at expiration, it gives you perspective. It helps you understand that a temporary paper loss isn't necessarily the final outcome if your original thesis, the stock staying in the range, is still valid.
It helps you ride out the noise.
Precisely. It helps separate the temporary fluctuations, purple line, from the ultimate potential, green line.
That clarifies things immensely. Let's touch on one more quick example, a long call, maybe on DIA, like in the source. How does its diagram reinforce the trade's parameters?
Okay, a long call on DIA, let's say it was the 176 strike price. The P&L diagram would show that distinct pivot right at 176.
The kink in a line.
Exactly. Below 176, the diagram shows a flat line representing your maximum loss. That loss is simply the debit you paid for the option, maybe $210 in this case, $2.08 per share.
So, max risk, clearly defined.
Visually obvious, and the break-even point. You just add that premium paid, $2.08 to the strike price, 176.
So 178.08.
Right around there. The diagram shows the P&L line crossing the zero barrier at that 178.08 price. You need DIA to trade above that level at expiration to start making a profit.
And above that, potentially unlimited profit again.
Correct. The line slopes up indefinitely past the break-even. It clearly illustrates that you've made a directional bet requiring a significant move just to break even, let alone make a good profit, but your downside is strictly limited.
What an incredible tour of these profit and loss diagrams. It really drives home that these aren't just abstract charts, they are absolutely essential tools.
Couldn't agree more. They're critical for understanding, for building strategies, and importantly for adjusting them confidently as market conditions change.
By really learning to read these diagrams, you gain such a deep insight, don't you?
You really do. You see how strategies make or lose money at different prices. You understand how to combine options to target specific outcomes like profiting, even if the market goes nowhere.
Like with the Iron Condor.
Exactly. And you understand the impact of time and volatility through those green and purple lines. Our hope is that this conversation really empowers you, the listener, to go explore these on your own trading platform.
Yeah, pull up different strategies, see how the lines change when you tweak strikes or expirations.
Play around with it. It's the best way to build intuition.
So here's something to think about. Imagine if you could genuinely see the full risk and reward profile of every single trade before you commit any capital. How would that change your confidence? How would it change your discipline, your whole approach?
That's the power here. These P&L diagrams are probably the closest thing we have to that kind of foresight in options trading.
If you enjoyed this episode and want to stay ahead with fresh insights every other day, don't forget to hit that subscribe button or follow our podcast. We've got more exciting content coming your way, and we can't wait to have you back. See you soon.